Morning guys, today is the 30th of September 2021. Just a quick update from me regarding one or two points that have been raised over the course of the last few weeks. Thank you very much for your feedback from the last video. I'm hoping that the videos are perhaps easier to digest and easier to understand than my complex letters. Yeah, appreciate the responses there. The purpose of today's update essentially is to look at how we attribute value to assets that we have. Now, this is a subject matter, a particular area of what we're involved with that does need some fairly clear attention associated with it, and I'm hoping that I can dispel any myths or uncertainties that may exist around this particular subject matter. So, in the past, when we've had typical retail investments in the past, what we've tended to do is consider a medium to long-term view. So in my days as an advisor, for example, any investment report would be peppered with the usual phrases of taking medium to long-term view in order to maximise and optimise potential returns. Now, the reason for that had nothing to do with the way that we operate. It was simply based around the premise that over the medium to long term, any investments that had a stock market bias, an equity bias, would tend to, over that time period, even out any peaks and troughs and oscillations in the market that could upset short-term figures. Now, from our perspective, the reason why we talk about taking a particular timescale view is because our investments are very time sensitive, and it has nothing to do with the analogy and the way that I've just discussed for retail funds. They are, to some extent, physically locked in over a period of time. I'm going to go through some examples of how this operates, and hopefully this will add a bit more understanding and meat to the bones for you to consider. So, the first question, I suppose, is why would we look at these particular types of investments rather than any unitized or equity-based funds that are in the retail space and available for you to buy online or through a broker or otherwise every day of the week? And the reasons for that, of course, are that we have particular aspirations and objectives to achieve. And just running through them now, we're looking at balancing risk against reward. We're looking at trying to ensure that we have a high degree of transparency with the way that we operate. We need to ensure that we have the ability to compound with our investments as well. It's very, very important. And we have multiple timescales within those. So what I mean by that is that shareholders within Westminster have maybe different aspirations, and it's trying to, from a timescale point of view and otherwise, it's trying to cover all of those angles for everybody so that we have a one-size-fits-all solution. That's very, very difficult. It's very difficult as well when funds are moving in and out, and we have a kind of moving goalpost scenario as well to attribute value and look at valuations in a meaningful manner. And as a consequence, what we've had so far is this notion that we get looking at indicative figures or indications of where we are rather than exact figures, because in order to get an exact figure, what we would need to do is close everything off and divvy everything up accordingly. And we're not prepared to do that, and it would be foolish to do that mid-cycle. So the purpose of today's video is to discuss how these cycles operate, and I'm going to give one very straightforward example that hopefully will resonate and make some degree of sense. Of course, as well, what we have within Westminster is varying needs in terms of income and growth. That's we're trying to cover all eventualities there, and we're moving towards making sure that more and more of the areas that we are aiming to achieve are covered by the nature of our structure and our approach towards our investment strategies. So, one of the considerations that I think is worth giving an example, and this example sounds a bit abstract, and I've used this before, is this idea of a golden goose. So, if we were lucky enough to find such a mythical character or mythical creature, and we were prepared or able to spend, £1,000 on this goose, knowing that it would have a lifespan of a year, so 365 days. We may have some privileged information regarding the goose. I don't know why I'm talking about this in this manner, because it's all abstract anyway. But let's assume this golden goose lays a golden egg every day. and the golden eggs we can sell every single day for £3.30, for example. At the end of the year, the poor goose dies, bless him, and we have 365 eggs that we've sold at £3.30 a piece, which has given us roughly £1,200 return for our golden goose. Now, in the meantime, during the course of the goose's life, we have to assume that we can't sell the goose on. So on day one, we spent £1,000. If we want to bail out of this investment, it's going to cost us £1,000 because the goose hasn't laid one single solitary egg at this point. After 100 days, we know that the position that we would be in, and we would have 100 eggs at £3.30, so £330. So we're clawing back the initial capital outlay, and we know where our break-even point is, and we know what the expected profit will be at the end of it. So all of these metrics are known at the outset, which is very, very important to us. But what we don't have necessarily, and this is by design, we don't have the liquidity in the short term, or the ability to be able to bail out of the investment with the goose en route to the final outcome. But we know the final outcome, and we can peg to that. So in the context of our own investments, the way that we would operate there is we would say, well, we know we're going to have £1,200 back at the end of it. So let's amortize that and look at it on a daily accrual rate. So if we're looking at a valuation on this one solitary and in isolation, this investment within the goose, I'm trying not to laugh here, but we know where we would be should we wish to value it, so 3/4 of the way through the term. Okay, I hope that makes some sense, and it really is important to grasp this point. I'm going to actually bring this into context of proper investments in a moment, but from our perspective, what we're trying to achieve is this notion of being able to place a bet. So, for example, if we were betting that Arsenal would beat Manchester United on Saturday in a football match, we're covering both sides of the bet. So if there is a win, draw, or loss for either team, that we've made a return. And that's something that's impossible to get in typical retail funds. So the reasons why we have this complex structure that really needs to be understood for sanity purposes more than anything is because we're not prepared to be at the vagaries of the markets going up and down. And as we speak today, there's so many reasons on the horizon why we should expect sideways moving markets, or markets that are under pressure on the downside. And this is extremely important. Now, we've talked about this for a long, long time. If the market's grinding up, we're making money. If the market's moving sideways or going down, we're making money as well. So we have covered all eventualities on this example of a bet. And I'm going to add some context to this by looking at some numbers, which I hope will make some degree of sense. So here goes. I am going to make one or two assumptions here, and I'm going to not dumb this down, but explain it in simple terms without looking at the many other moving parts that exist. And this is just one trade. Okay, so it's just one example of one position, and we're not looking at how these things contingently link in other areas as well. So we're looking at here the SPX. SPX represents the S&P 500, the biggest index in the world. And we're looking at essentially buying a position or opening a position here at the 3,000 level on the downside. Now, this is essentially giving us insurance on the downside, and we're going to be spending a certain amount of money, as you would expect, to have this insurance in place. Now, the context and dynamics of the trade is that we're going out to 805 days in the future. Okay, and that takes us to December the 15th, 2023. Now, if we were to open this position, it's going to cost us a sum of money. It's going to cost us $16,920. So if we had $100,000 dollar account, that would essentially cost us $84,650. So out of our $100,000 we have physically spent $84,650. Now, I'm going to assume that money is dead money. I'm going to assume that we are in a position that we cannot then offload in any secondary market. That's not necessarily the case, but the way that we would do this to optimize returns is the case, so we don't give ourselves that get out. Now, this figure here represents the cost per day of this particular insurance, which is $26. So we know where we stand from a cost per unit and cost per day position, and we can enter this position knowing full well where we stand should the market move to the downside. Okay, what I'm now going to do is I'm going to look at a short-term position, and I'm going to go 50 days out from where we are now. And just get my numbers right here, and I'm going to put a position on which essentially is the opposite to the trade that we've just considered. So it's almost, as I said, with the Man United and Arsenal position, it's taking the other side of the bet on. So and I'm going to base this on the 4,000 put level for November the 19th of this year, so 2021, going out 50 days to expiry. Okay, so the premium that we're going to receive for this is 3,880. Okay, so in essence, the amount of money that we're going to receive for this position on a daily basis is roughly $100. So if we assume that we've taken in $100 and we have spent $26, we know that we're making $74 per day from this particular trade. Now, the assumption is here that we have to stick to this 806 days to expiry for the longer dated position, and we're using that as collateral and as insurance to be able to open shorter dated positions against that. I know that we're looking at 4,000 and 3,000 in terms of the levels here, but believe me, this will wash out perfectly well for us. So in essence, what we're making is $74 per day profit on this position, which is $27,000 per year. Okay, and this is a locked-in position on 100 grand. All we need to do is to allow this to play out in terms of the maths, whether the market goes up, down, sideways, or whatever. We know what we're going to expect to achieve within a very defined and very narrow margin, and this really is important. As I said, the only thing we need to do is to make sure that we stay in the trade for the 806 days and run this position through to that particular expiry. If we try and unwind it and bail out between now and then, it will materially affect our returns. Now, what I'm going to do now is explain, hopefully, how the nature of this particular trade would be affected if we were to bring the 806 days to a shorter time scale. Excuse me, just waiting for the postman to arrive. Okay, so we were to establish the same position. So the 3,000 put. Okay, going 350 days, so roughly a year, so that's Sep 16, 2022. The 3,000 put we are looking at purchasing here is going to cost us $34 a day. So we've gone from $26 to $34 a day, and if we were placing the short-term position against that, I'm just looking at my numbers here to make sure they make sense. We are making, in this example, $66 opposed to the $74 on the longer dated position. So that means that over the course of the year, we're making $2,920 less per year. So we're making 10% less per year, which is massive, by going out 1 year as opposed to 806 days. Okay, so this really adds a lot of credibility to this notion that by having the longer dated position that we're using shorter positions against, okay, so taking both sides of the bet, the cost per unit and cost per day of the insurance, quote unquote, is much more optimal and is better for us to take that longer term approach. Okay, so if we were insuring a van for the day, it would cost us X. If we were insuring the van for a year, it wouldn't necessarily cost us 365 times X. It might be 100 times X. So in terms of the average cost per day, per week, per month, this is the sweet spot where we need to be. Now, a lot of our investments historically have taken a 5-year view, 6, 7, 8-year view as well, and they've matured really nicely for us. Now, given that there are likely to be alterations with our strategies moving forward, and if you're receiving this video, that would be an indication that you will be invited to have your own account ultimately to be able to monitor your own positions, your own trades. They'll all be much more transparent, and you'll essentially be logging into a system, and you can take money in, put money in, take money out. You can do what on earth you like with your own money. Once we're in that position, that will alleviate the need to have a limited company and all the associated hassle with that, and it will take a lot of strain off those who are involved in this day-to-day management of funds, which will be a bit of a godsend. And I think the time is really due for us to kind of address that, because I do believe right now that there are a broader spread of aspirations now and objectives than there perhaps have ever been. But going back to the old methods of investing would be a foolish and nonsensical thing to do, because I think the risks are just ridiculously high, and we've had this nicely protected culture over the last number of years within Westminster that we've had experts giving us guidance that would only be available to hugely high net worth individuals, and for the type of people that I do consultancy work with who work in that sort of space as well. So one of the questions that may be bubbling to the surface is, well, why don't we look at this on a renewal basis of, say, 6 months to a year? Now, this question has been posed a fair bit, and I think the answer now will make perfect sense to you. If for example, we were to look at doing this on a yearly basis over a period of 5 years, at the end of the year, end of the 5-year period, the amount that we would receive in terms of the net equity growth over and above taking a 5-year view from the outset, the difference would be enormous. Doing it on a yearly basis would represent a third of the value at the end of that 5-year period. So, at the end of the year, the chances are an investor would go, oh, that's great, let's do it again, a year, and so on and so forth. And that really defeats the whole object here. So by giving ourselves the ability to have a backstop position that we are opening positions against, i.e. taking both sides of the bet, and allowing the premium that we are receiving, the income that's coming in, to compound over the period, is where we get the returns. And I cannot stress the importance of this enough. Okay, so moving forward, I will be providing much more details on how we will be proposing to alter things in the future. It's not going to happen immediately. We do have fund managers who are assisting us, who are contractually obligated to do so for some time, and once those obligations have been rescinded and through the natural passage of time, we will change things accordingly. Now, the absolute latest that the positions that we have will expire is 2026, December the 31st. I think that the objective really will be to bring that timescale into a much more easy reach of where we are now. I don't want to put too many figures and numbers out there, but I do think that it's necessary for us to alter the way that we're operating for the benefit of all. Now, this will not involve any work from anyone within Westminster. We will still have the same nature of updates and still the same communications, unfortunately, from me and others. But I think that it will be the sensible route forward. So I do hope that makes sense. This is really a version of events that have removed all of the moving parts that are pertinent to this, just to draw back and peel back the layers so you can see the numbers here and to see why it is more appropriate for us to look at particular timescales, make our bed and lie in it, and then not be disruptive along the way. So this type of strategy is not putting the money in the deep freeze by any stretch of the imagination, and it hasn't been from day one. But it should form the core of what we're doing, because surely the most important considerations will be where are we going to be when we reach a point in time as our ultimate destination, and how much risk have we endured along the way. Okay, so I think that's the important thing to consider here. So I will provide some more examples of this in due course. I hope this has been of interest, and I will catch you on the next video.